Hey there, smart investors. Michael Beresford back again from OpenCorp for today's Property Wealth What. We're continuing the theme of recent times today, providing some market commentary on some articles that are appearing in popular press. And this one's a cracker. This one would probably appear most weeks, titled Interest Rates Put on Hold at 2%, but for how long? So we'd all hate for interest rates to go up, wouldn't we? Well, they have been at record lows for a long time. Yes, you get used to what's happening, but I'm here today to talk about why one of the most common questions that we get asked is really one of the smallest things that smart investors should be worrying about. And that is, what if interest rates go up? Okay, so to answer the question from the article, there's a whole bunch of speculation about, yes, interest rates have been low, and the RBA's recent decision to hold interest rates for yet another month, has provided stability, and the whole speculation about whether the next move will be up, the next move will be down, and a whole bunch of opinions from experts is what's in the article. Let's look at it practically though, okay? So let's have we'll actually break down a property example, okay, using a conservative interest rate today. That's how we roll. We use conservative numbers. And then I'll talk to you about, well, if interest rates go up, what impact does that have? And why is that impact actually much smaller than what you might think? Okay. So let's say that we're looking at a property under the median house price, say 500K, okay? Now let's add some costs to that. Let's call it 30K in costs. Means that we've got a total purchase price of 530,000, and we'll assume all of that is coming from equity or borrowed money. Okay, so we're paying interest on the whole lot. Now you can get rates well under 5% today, but let's assume that 5% is the interest rate. What are we looking at there? A bit under $27,000 in interest only. Okay. With any investment property, rates, insurance, property management, probably pest control, let's call that 5,000 as a round number in costs to hold. So annually, we're looking at about $32,000 a year to hold this property worth 500K. Okay? Now, we've also got some income to be able to help hold this, the main one being the rental income. Now, if we're getting, I'm going to use a conservative rent here, okay? On a $500,000 property, you'd be expecting about $430 per week for a solid growth property, okay? So $430 per week times 52, what are we looking at there? About 22,600 for the year in rent. Okay. Now, not only do we have rental income that comes in, but we also have tax benefits in the form of depreciation. Okay. Now, for those of you that aren't familiar with what negative gearing is or how tax benefits work with property, okay, let's assume this. Let's assume on a growth property that you have depreciation, okay? Depreciation's gold because it doesn't actually cost you anything to get additional deductions. So not only can you tax deduct the holding cost in terms of interest and running expenses, but a good growth property is going to have about $10,000 worth of depreciation or additional deductions in the first year. Okay, and you get a depreciation schedule or a quantity surveys report that can specify that for your accountant. So in total, we're looking at $42,000 worth of deductions here. Okay, there'll be some bank costs and so on that you can also write off. So let's say, as a round number, it's $45,000 in total deductions. Okay, now, if we're looking over here, let's look at income. So if we take an income pretty close to the national average, 90K, then on that money, okay, you need to be paying the amount of tax that you pay per year is around $21,000, a little bit over. Okay, so there's some tax calculators on the ATO website, www.ato.gov.au. Just put it into Google, it'll pop straight up and you can play around with tax benefits. That's what you need to pay before you take into account the property. When you have a property though, your new taxable income is calculated as being your salary, assuming no other deductions, plus the rental that comes in, minus all of the tax deductions. So having $45,000 of total deductions here doesn't mean that you get $45,000 back. Okay, what it does mean is that it reduces your taxable income to the point where here, let's make this easy and call this 23 for me. 68 off that, just 45. 68,000 is our new taxable income. Okay. Now, if you're earning 68,000, then the tax on that is going to be about 13.5, using round numbers. Okay. So the difference between what you have to pay in tax on a 90k taxable income and the tax that you now have to pay on a reduced taxable income, that difference, let's call it $8,000, comes back into your pocket. Okay? So, for those of you that have seen other WODs, you'll know that we've talked about 3 sources of income that go towards holding a property. There's rental, there are tax benefits, and then there's a small amount out of pocket. Okay, so if we look at that and we say, well, to hold this property every year, we need to come up with $32,000, assuming a 5% interest rate. Of this 32, 22,600 comes from the rent, 8,000 comes from the tax benefits. So what's left? $1,400 for the year. Okay, divide that by 52 and round numbers, guys, on a 5% interest rate for a quality growth property, this investment would cost you $30 a week out of your pocket to hold. Okay, now remember, this is on a 5% interest rate. What happens if rates go up? Then obviously the holding cost will go up with it. But what's more important to think about is what would cause interest rates to go up. So when interest rates go up, that's typically in response to growth in the economy and inflation. And when that happens, house prices are increasing and wages are increasing. Okay, so if we look at the classic case, everyone talks to me about, yeah, Michael, but I remember when interest rates were at 17%. That's great. Do you know how much the median house price grew between 1987 and 1989 when interest rates were that high? They grew 50%. So let's look at that. Interest rates won't get that high again, but let's say that they grew substantially to the point where your interest bill was phenomenal. Okay? A large percentage of the holding cost is still coming from other people. Rents would go up because landlords pass that cost on to tenants. Remember, your tenants have had wage growth. They're earning more, so they can pay more in rent. You're not going to lose your tenant because the rent goes up. Okay? If your interest costs are higher, you're going to be getting more tax benefit, so more will be coming from over here. But if this $500,000 property grew significantly because of the growth in the economy, and interest rates only respond to that, remember, so interest rates move after the growth has happened, they don't move first, then you would have created substantial equity here, where if you needed to take another $10,000 out of that equity in a line of credit to cover an increased holding cost, you could. And I don't know anyone out there that wouldn't agree to pay $10,000 to get $200,000. Arbitrary numbers, guys, but you get my point. Okay, so hopefully that helps you understand interest rates a little bit more. Okay, yes, interest rates are low now, Who knows what they're going to do next? At some point they will go up. But the bottom line is, for virtually free growth, you can be in the market and your borrowing capacity is better off because interest rates are lower. So if you've been thinking about investing for some time, you're never going to get a better time to buy than now, because yes, interest rates will rise in the future, prices will respond with that, as will rents, but you'll be able to maximise the number of investments you can acquire with low interest rates to maximise your borrowing capacity. Catch you next time.